A liquidation preference is the term sheet clause that decides how much money a founder actually gets when their company sells. Now, as a 2x founder myself who runs a law firm that helps startups raise capital and exit, I've watched dozens of founders sign deals where this clause could cost them anywhere from a few $100,000 to tens of millions of dollars. And the worst part is they didn't even notice until the money was being wired. So in this video, I'm walking you through everything you need to know about how a liquidation preference works, so you can make sure you get the money you're expecting when you sell your company. So let's get into it. How investors get paid first. First, let's talk about what a liquidation preference actually does at exit. When you raise money, VCs don't just buy common stock the way you and your team have. They buy what's called preferred stock. And preferred stock comes with a set of extra rights, the most important being a liquidation preference. What that means is when your company sells, the people with preferred stock get their money back before anyone with common stock gets $1. So let me give you a quick example to make this concrete. Let's say an investor puts $5 million into your company in exchange for 25% ownership. Then a few years later, you end up selling that company for $10 million. Without a liquidation preference, that investor would just get 25% of the sale, which would be $2.5 million, and the rest would go to you and your team. But with a 1x liquidation preference, they get their full $5 million back first, and the leftover $5 million goes to you and your team. So in this case, that one clause is the reason the investor walks away with double what they would have got without it. The reason every investor asks for this is because most startups don't return money. The vast majority of venture-backed companies either fail or sell for less than they raised. So investors use the liquidation preference as protection to make sure that even in a smaller exit, they get their original investment back before founders take a single dollar. Next is the multiple, because not every liquidation preference is the same. So in the example I just walked through, the investor got back $5 million on a $5 million investment, which is what we call a 1x preference. But preferences can also be 2x, 3x, or even higher, depending on what the investor and you negotiate and agree on. And every additional multiple takes more money away from you at exit. So let me show you what that looks like with a 2x preference. Same setup as before. Investor puts $5 million into your company for 25% ownership. But this time, they get a 2x preference. So they don't just get their $5 million back, they get $10 million back before anyone else sees $1. So if you sell for $10 million, the investor takes the entire sale price and you and your team end up with nothing. And this happens a lot. I want to be clear though. The 1x preference is the market standard. Across all the deals I've seen, fewer than 1 in 10 have a liquidation preference higher than 1x. This is because higher multiples are aggressive terms that signal to future investors and employees that the company isn't being run with founder-friendly terms. So if an investor comes to you asking for 2x or 3x preference, that should be a red flag, and we'll talk about how to counter that later in this video. By the way, if you've already been sent a term sheet and want someone to walk through your term sheet with you before you sign anything, click the first link in the description and book a free consultation with me. We've negotiated hundreds of these for founders, and I can tell you within minutes if the terms you're being offered are fair. So let's get back to the video. Participating versus non-participating. Now we get to the variation that does the most damage at exit. This is where the preferred stock is non-participating or participating. These are two ways that the same liquidation preference can play out at exit, and the difference between them can cost you millions when you sell. With that said, I'm going to break down both right now so you know exactly what to look for in your term sheet. So let's start with non-participating preferred, because that's the version most investors and founders agree on. With non-participating preferred, the investor has to choose between two options when the company sells. They either take their liquidation preference, meaning they get their money back first, or they convert their preferred stock into common stock and take their percentage ownership of the entire sale. What this means is the investor picks whichever option pays them more, but they only get to choose one of them. Now, participating preferred is where things get a lot worse for founders. With participating preferred, the investor doesn't have to choose. They get both. So they take their liquidation preference first, meaning they get their original investment back, and then they take their percentage ownership of whatever's left over. That's why this is sometimes called the double dip, because the investor is dipping into the sale proceeds twice. Once for their preference and once for their percentage of what's left. So let me walk you through what that looks like with real numbers. Let's say an investor puts $5 million into your company for 25% ownership, and a few years later, you sell your company for $40 million. With non-participating preferred, the investor has to choose between taking their $5 million preference or converting to common stock and taking 25% of the full sale, which would be 10 million. Obviously, the investor is gonna pick 10 million, and then you and your team split the remaining 30 million. But with participating preferred, the investor first takes their 5 million investment preference back, and then they take their 25% of the remaining 35 million, which is another 8.75 million. So they end up with 13.75 million total, and you and your team are left with 26.25 million instead of the 30 million in the other example. In other words, that one variation just cost you and your team 3.75 million on the same exit. Now, if an investor asks for participating preferred, you can counter by asking for a cap on the participation. A cap means the investor can only take their participation up to a certain amount of their original investment. For example, a 3x cap means that no matter how big the exit gets, the investor can never take more than 3 times their money out of the participation. So with a 3x cap on a $5 million investment, the most they could ever take total is 15 million, and everything above that goes to you and your team. Caps don't eliminate the double dip entirely, but they limit how much extra the investor can take on bigger exits. How to negotiate. All right. Lastly, I want to talk to you about what you should actually negotiate for in your term sheet. As I mentioned, the market standard you should be aiming for is a 1x non-participating liquidation preference. That's because it gives the investor reasonable protection if the company sells for less than they invested, without taking too much of the gains if the company sells for more. If an investor offers this from day one, take it and focus your negotiating energy on the other terms in the term sheet. If the investor asks for something more aggressive than 1x non-participating, here's how to respond. If they ask for 2x or 3x preference, the counter is to negotiate it back to 1x and explain that fewer than 1 in 10 venture deals have anything above 1x, and anything more aggressive than that will hurt your ability to raise your next round, because future investors will see those terms and either demand the same protection for themselves or walk away from the deal entirely. If they insist on participating preferred, the counter is the cap that I just walked you through. Start by countering with non-participating. That's the cleanest version. If they won't move off participating, negotiate a cap on the participation. Anything above a 3x cap defeats the purpose, because at that point you're just giving them too much room to take from the exit. And what gives you the power to ask for terms that are most favorable to you comes from 3 places. The first is having competing term sheets, because when you have multiple investors interested, you can play them against each other on terms. The second is having strong metrics that show your company is one of the few that's going to return capital, because investors compete harder for those deals. The third is just knowing the market norms, because most investors will respect terms that are standard and most won't fight hard for terms that aren't. Lastly, if an investor refuses to negotiate any of this, you need to be willing to walk away from the deal, because an investor who's aggressive on your term sheet is going to be aggressive in your boardroom and through every major decision down the road. I've watched founders sign aggressive term sheets thinking that they could make it work, only to regret it when those terms cost them millions at exit or control of their company along the way. So if the terms are clearly outside market norms and the investor won't budge, walking away is usually the right call, even if it costs you a few months looking for a different investor. Now, if you've been sent a term sheet and you're not sure if what you're being offered is fair, click the first link in the description and book a free consultation with me. We've negotiated hundreds of term sheets for founders from angel rounds through Series A, and we know exactly what to negotiate for and what to walk away from. On our call, we'll go through the terms you're being offered, identify clauses that may be more aggressive than what most investors actually offer, and map out exactly how to negotiate it back to a fair deal. So again, you can book your consultation by clicking the first link in the description. And if you want to see this in a real Series A negotiation, then check out my video on how this company raised 11 million without giving control of their company.